If your job disappeared tomorrow, how would you pay your bills next month? What if I told you there's a way for your money to work for you day and night, even while you're sleeping or enjoying retirement? That's the dream of dividend passive income. But I know you might be thinking, where do I even begin? Do I need a fortune to get started? In this video, I'm going to pull back the curtain and walk you through, step by step, how to actually start ETF investing. I'll share every single piece of knowledge you need to get going, even if you're a complete beginner and only have $10 to start. Yep, you heard that right, $10. So stick around until the end because I'm going to show you exactly how to start making $500 a month from dividends. No fluff, just real actionable steps. I've personally built ETF portfolios that consistently generate income for me, month after month, year after year. And that's why I'm so passionate about sharing these key insights with you so you can build and grow your very own dividend income generating machine, even if you're starting from absolute scratch. I'm not here to waste your time with fluff. We're cutting through all the noise. We're going to focus on practical and actionable guidance, specifically tailored for investors in the US, UK, Canada, and Australia. We'll dive deep into two of the most talked about ETFs in the investment world, SCHD and VTI. But we won't stop there. I'll also reveal other compelling options that could generate even more passive income for you. This isn't just another generic investment guide. We're going to tackle the real questions that keep potential investors up at night, like how much should you start with? Which platform should you use? What are the tax implications in your specific country? How do you actually place your first order? And most importantly, how to build a dividend portfolio that will generate you passive income monthly. Let's start with the basics. What's an ETF and how does it work? Think of an ETF like a basket, but instead of fruit or groceries, this basket holds different kinds of investments, like stocks or bonds. Now here's the cool part. This basket is traded on the stock market, just like a regular stock. So when you buy an ETF, you're not just buying one company, you're buying a small piece of everything inside that basket. That could be dozens or even hundreds of different companies, all in one go. It's kind of like a mutual fund, but you can buy and sell it anytime the stock market is open. Here's where ETFs really shine. They're super simple and super efficient. Instead of spending hours trying to pick the right stocks one by one, you can just buy one ETF and boom, you're instantly invested in a bunch of companies at once. It's like skipping the stress of choosing every single ingredient and just grabbing the full recipe, ready to go. This helps you spread out your money, which lowers your risk. So if one company in the mix has a bad day, it doesn't hurt your whole investment too much. Because your money's not all riding on just one or two companies. And here's a money-saving bonus. Most ETFs are way cheaper to own than traditional mutual funds. While some mutual funds might charge 1% to 2% a year just to manage your money, many ETFs only charge around 0.1% or even less. That might not sound like a big deal right now, but over the years, those lower fees can save you a lot, like a lot. Now that you have a grasp of what an ETF is, let's talk about the different types you'll bump into. Don't worry, I'm not going to overwhelm you with a million options. We're going to focus on the ones that matter most for beginners, starting with broad market ETFs. These are your bread and butter as a beginner. They own stocks from across the entire stock market. The most popular one out there is VTI, the Vanguard Total Stock Market ETF. This single ETF owns over 4,000 US companies. From massive giants like Apple all the way down to small companies you've probably never even heard of. When you buy VTI, you are literally buying a piece of the entire US stock market. How cool is that? Next up is the S&P 500 ETFs. This focuses specifically on the 500 largest companies in the US. Popular options include VOO and IVV. While they're slightly less diversified than total market ETFs, they are still incredibly safe and have been the foundation of countless successful portfolios. Just think about it. The S&P 500 has averaged about 10% returns per year over the past 90 years, navigating through the Great Depression, multiple recessions, and even 2 world wars. That's resilience. Now let's talk about SCHD and why almost 80% of investors choose it. The Schwab US Dividend Equity represents a very specific and smart philosophy in dividend investing. It's not about just chasing the highest dividend yields out there. Instead, SCHD uses a more sophisticated approach that focuses on dividend quality and sustainability. SCHD tracks the Dow Jones US Dividend 100 Index, which selects companies using a rigorous screening process. Companies have to have paid dividends for at least 10 consecutive years, show strong financial health, think return on equity, debt-to-equity ratios, and good cash flow, and maintain reasonable dividend yields that suggest they're strong and stable, not desperate. From recent data, SCHD typically holds around 100 stocks, with its biggest positions often being established companies like Broadcom, Texas Instruments, Cisco Systems, Coca-Cola, and Pfizer. These aren't the flashy, get-rich-quick growth stocks that grab headlines. These are the solid, reliable companies that form the backbone of the U.S. economy. Companies with proven business models, strong competitive advantages, and management teams dedicated to returning cash to their shareholders. Important note: if your main goal is to generate monthly dividend income, SCHD is probably not your best bet. Historically, SCHD has delivered both competitive total returns and attractive dividend income. The fund typically yields between 3% and 4% annually, which is significantly higher than the broader market average. Plus, it still manages to achieve capital appreciation that keeps pace with or even beats broader market indices over longer periods. This combination of income and growth makes SCHD particularly appealing for investors nearing or in retirement, those looking for current income, or anyone who just loves the psychological comfort of receiving regular dividend payments while still building long-term wealth. Just remember, SCHD only pays out quarterly. Let's quickly touch on the taxes involved in investing in SCHD. The tax treatment of SCHD varies pretty significantly depending on your country and your individual situation. In the US, most SCHD dividends qualify for favorable tax treatment as qualified dividends, which means they're taxed at capital gains rates rather than ordinary income rates for most investors. For international investors, it gets a little more complex. UK investors will face withholding taxes on US dividends, though some treaty provisions might offer a little relief. Canadian investors benefit from favorable tax treaty provisions but still need to navigate foreign tax credits. Australian investors face similar withholding tax issues but might benefit from franking credit equivalents in their domestic tax calculations. It's always best to check with a tax professional for your specific situation. Now, let's discuss VTI as one of the best options for beginner investors. The Vanguard Total Stock Market ETF, or VTI, takes a fundamentally different approach from SCHD. Instead of focusing on dividend-paying companies, VTI aims to own the entire U.S. stock market. This means you get exposure to over 4,000 individual stocks across all market sizes and sectors. VTI tracks the CRSP US Total Market Index, which includes small-cap, mid-cap, and large-cap stocks in proportions that reflect their market capitalizations. This means that while huge companies like Apple, Microsoft, and Amazon make up significant portions of the fund, you also get exposure to smaller, potentially faster-growing companies that could become tomorrow's market leaders. With an incredibly low expense ratio of just 0.03%, VTI is one of the most cost-efficient ways to get broad U.S. market exposure. This ultra-low fee structure means that almost all of your investment dollars are actually working for you in the market, rather than going to fund management fees. If you're outside the U.S., VTI can be purchased directly through most Canadian brokers. However, you can also opt for currency-hedged alternatives like the Vanguard Total Stock Market Index ETF, VT, in Canada. For dividend-focused investing similar to SCHD, Canadian investors might consider the iShares Core High Dividend ETF, XEI, which is Canadian domiciled and can offer tax advantages for Canadian investors. Australian investors face similar challenges to UK investors when it comes to direct access to the US ETFs, but they also have unique domestic considerations around franking credits that can make Australian dividend-focused ETFs particularly attractive. One excellent alternative for Australian investors is the BetaShares Australia 200 ETF A200, which gives you broad Australian market exposure while maintaining the benefits of franking credits for Australian taxpayers. Also, Australian investors interested in dividend strategies similar to SCHD might consider the BetaShares Australian Dividend Harvester Fund, HVST, which provides exposure to high-dividend Australian companies while using covered call strategies to potentially boost income. Here's a little secret. Rather than choosing between SCHD and VTI, many of the most successful investors I know actually use a core satellite strategy that incorporates both types of funds to achieve different objectives within a comprehensive portfolio. The core typically consists of broad market exposure through funds like VTI, providing that rock-solid foundation for long-term wealth building and broad market participation. The satellite positions might include more specialized funds like SCHD for income generation, sector-specific ETFs for targeted allocations, or international funds for global diversification. This smart approach allows investors to maintain broad market exposure while customizing their portfolios based on their specific goals, risk tolerance, and market outlook. Your optimal ETF allocation should actually evolve with your life circumstances and investment timeline. Younger investors with decades until retirement might lean heavily on growth-oriented funds like VTI, accepting higher volatility in exchange for potentially higher long-term returns. As you get closer to retirement, the regular income and lower volatility characteristics of dividend-focused funds like SCHD become increasingly attractive. However, this doesn't mean abandoning growth entirely, as many retirees will need their portfolios to last for decades and must continue growing to maintain their purchasing power against inflation. So, here's my top recommendation for beginners. Start simple. Seriously, pick just one or two broad market ETFs and focus on consistently investing in those. You can always add complexity later, but there is absolutely nothing wrong with keeping it simple forever. Some of the wealthiest people I know have portfolios with just 2 or 3 ETFs. Simplicity often wins. Go watch this video above where I explained in detail the exact amount you need to start making $500 monthly from dividends as I promised from the beginning of the video. Now let's talk about choosing your brokerage platform. This is a big one, as your choice of brokerage platform significantly impacts your ETF investing experience and your long-term costs. In the US, major platforms like Fidelity, Schwab, and Vanguard offer commission-free ETF trading, extensive research tools, and competitive account features. For UK investors, consider platforms like Hargreaves Lansdown, Interactive Investor, or AJ Bell. Just keep in mind that platform fees, currency conversion costs, and the available fund selections can vary quite a bit. Many UK platforms now offer stocks and shares ISAs, which are amazing because they can shelter your ETF investments from capital gains and dividend taxes. Canadian investors have access to platforms like Questrade, and Australian investors might look at platforms like CommSec, SelfWealth, or Interactive Brokers Australia. Always evaluate brokerage fees, available markets, and how well they integrate with Australian tax reporting requirements. Here's the deal. The type of account you choose can dramatically impact your long-term investment returns through tax optimization. If you live in the US, always prioritize tax-advantaged accounts like 401ks, IRAs, and Roth IRAs before you even think about investing in taxable accounts. UK investors should absolutely maximize their ISA allowances using stocks and shares ISAs to shelter ETF investments from UK capital gains and dividend taxes. The annual ISA allowance provides significant tax-sheltered investment capacity for most investors. Canadian investors should prioritize TFSAs, tax-free savings accounts, and make sure they understand the different tax treatments and withdrawal rules for each account type. The tax-free growth in TFSAs can significantly enhance your long-term wealth building. Australian investors should consider superannuation contributions and self-managed super funds for long-term retirement investing, while also utilizing any available tax-advantaged investment accounts. All right, let's talk about the big question for new investors. Dollar cost averaging versus lump sum investing. Which one makes the most sense when you're just starting out? The question of whether to invest a lump sum all at once or spread investments over time through dollar cost averaging is one of the most common dilemmas new ETF investors face. Lump sum simply means investing all your money at once. Sometimes I even call it blind investing, because even billionaire investors don't just throw all their money in at once. Dollar cost averaging offers psychological benefits that you absolutely shouldn't overlook. Many investors find it much easier to commit to regular monthly investments rather than making huge lump sum decisions. And the reduced volatility of gradually investing can really help investors stick to their long-term plans, especially during market turbulence. If you're new to ETF investing, prioritizing dollar cost averaging should be your best option. The more you understand the market, the more you can gradually increase your risk if you choose. Here's a crucial mindset shift. You're not trying to get rich overnight. You're building a habit of investing consistently over time. It's far better to invest $100 every month for a year than to invest $1,200 once and then just stop. Consistency is key. Now, how should you allocate your funds when investing in ETFs for long-term wealth? One of the most popular and effective portfolios for beginners is the 3-fund portfolio. It typically consists of 55% US total stock market, like VTI, 35% SCHD for that dividend focus, and 10% bonds, like BND for stability. This gives you exposure to virtually every stock and dividend-paying companies in the world, plus some bonds for that crucial stability. A common rule of thumb is to subtract your age from 110 to determine your stock allocation. So if you're 40, you'd aim for around 70% ETF and 30% bonds. If you're 60, you might have 50% ETF and 50% bonds. The idea here is that when you're young, you have more time to recover from market downturns, so you can take on a bit more risk. As you get older and closer to retirement, you generally want more stability in your portfolio. If even a 3-fund portfolio feels a bit too complicated, start with just one fund. VTI or SCHD are excellent choices that give you broad exposure to the US stock market. You can always add more later. The most important thing, I can't stress this enough, is to start. Don't let perfect be the enemy of good. A simple portfolio that you actually invest in consistently is infinitely better than a perfect portfolio that you never even begin. Over time, your portfolio will naturally drift from your target allocation. If your ETFs do really well, you might end up with, say, 80% dividend-paying ETFs instead of your target 50% for those approaching retirement. So, once or twice a year, you should rebalance by selling some of what's done exceptionally well and buying more of what's lagged behind. This forces you to buy low and sell high systematically. It might feel counterintuitive to sell your winners and buy your losers, but it's actually one of the most effective ways to improve long-term returns. Many brokerages now offer automatic rebalancing, which makes this even easier. You set your target allocation, and they do the work for you. If you're an investor who really wants to see that dividend income hitting your account every single month, there are smart ways to set up your portfolio to achieve that. It's all about finding strategies that deliver consistent cash flow, even with the unique quirks of funds that pay out frequently. Instead of putting all your funds into monthly dividend ETFs, consider a core satellite approach where monthly payers form the satellite positions around a core of high-quality quarterly dividend funds. This strategy might allocate 30 to 40% to monthly dividend ETFs, like JEPI and JEPQ for consistent cash flow, while maintaining 60 to 70% in quarterly pairs like SCHD and VTI for long-term wealth building. The choice between monthly, quarterly, and annual dividend strategies ultimately comes down to balancing your current income needs against your long-term wealth building objectives. All in all, I personally like SPYI for reduced volatility, SCHD for its low management fees, and QQQI and JEPQ for exposure to the exciting technology sector. This really illustrates how different dividend strategies serve different investor priorities. Monthly dividend ETFs are fantastic for providing steady cash flow, but might sacrifice some long-term growth potential. Quarterly dividend funds like SCHD offer a better balance of income and growth, while broad market funds like VTI prioritize long-term wealth accumulation with a more modest current income. The optimal choice depends on your life stage, your income needs, your personal risk tolerance, and your investment timeline. Younger investors might prioritize growth-oriented quarterly pairs, while retirees might prefer the steady cash flow of monthly dividend strategies, possibly combined with some growth exposure to fight against inflation. Understanding these payment frequencies and their implications allows you to build an ETF portfolio that aligns perfectly with both your current income needs and your long-term financial objectives. Before making your first ETF purchase, take a moment to clearly define your investment objectives, your timeline, and your risk tolerance. Are you investing for retirement decades in the future? Saving for a house down payment in 5 years? Or seeking current income to supplement other earnings? Your goals should always drive your ETF selection and allocation decisions. Seriously, write down your specific objectives, your timeline, and your expected contribution schedule. This written plan will be your anchor during market volatility and will help you resist the temptation to make emotional investment decisions based on short-term market movements. Contrary to popular belief, you truly don't need thousands of dollars to begin ETF investing. Most major brokers now offer fractional share investing, allowing you to purchase portions of ETF shares with as little as $1. However, starting with at least $100 to $500 generally provides more flexibility and helps reduce the impact of any remaining transaction costs. When you're ready to make your first purchase, understand the difference between market orders and limit orders. Market orders execute immediately at the current market price, while limit orders allow you to specify a maximum purchase price. For liquid ETFs like SCHD and VTI, market orders during regular trading hours typically provide fair execution. Try to avoid trading during the first and last 30 minutes of the trading day when spreads tend to be wider and volatility higher. The best execution usually happens during midday hours when markets are most liquid and stable. Okay, let me share the biggest mistakes I see beginners make so you can easily avoid them. Mistake number 1, trying to time the market. I can't tell you how many people say, "I'm just waiting for the market to crash so I can buy in." Here's the raw truth. No one can consistently predict when the market will go up or down. Not professional investors, not financial gurus, not anyone. Not even me. Time in the market beats timing the market. The best days in the stock market often happen right after the worst days. If you're sitting on the sidelines waiting for that perfect moment, you'll likely miss both the crashes and the powerful recoveries. Mistake number 2, over-diversification. Some beginners think more ETFs equals better diversification, so they end up with 15 different ETFs, or even more. This just creates unnecessary complexity without any additional benefit. Remember, a single broad market ETF like VTI already gives you ownership in over 4,000 companies. You absolutely do not need 10 more ETFs to be diversified. Keep it simple. Mistake number 3, chasing performance. Last year's best performing ETF is very rarely next year's winner. Beginners often look at which ETFs did best last year and pile all their money into those. This is a recipe for disappointment, trust me. Instead of chasing fleeting performance, focus on broad market ETFs with long track records of steady, consistent growth. Boring consistency beats flashy, short-term performance every single time. Mistake number 4, panic selling. Listen, this is the really tough part. When the market inevitably takes a dive, and trust me, it will at some point, your gut reaction will scream at you to sell everything. Just to stop the bleeding. Think about it. Every single major market crash we've ever seen has eventually bounced back. The folks who held on, who rode out the storm, not only got their money back, but usually ended up even better off. Those who panicked and sold, they locked in their losses for good. Don't be that person. Mistake number 5, not starting early enough. The biggest mistake of all is simply not starting. I meet people in their 40s and 50s who look at me and say, "Man, I wish I had started investing in my 20s. Don't be that person. Even if you can only invest $10 a month right now, start with that. The habit is infinitely more important than the initial amount. You can always increase your contributions later as your income grows. As I wrap up, let me give you some final practical tips to set yourself up for incredible success. Start small and learn. Don't feel like you need to invest thousands of dollars right away. Start with whatever you can afford to lose sleep over. Even $50 or $100 per month is a fantastic beginning. Use this small start to get comfortable with the process. Learn how your brokerage platform works. Get used to seeing your account balance go up and down. Build the emotional discipline that successful investing requires. If you're just starting out, here are my top recommendations for those broad market ETFs. VTI, Vanguard Total Stock Market. This one lets you own a slice of practically every US company out there. It's incredibly diversified. VOO, Vanguard S&P 500. With VOO, you're investing in the 500 biggest, most established companies in the US. It's a true blue-chip stock. SCHB, Schwab US Broad Market. Think of this as Schwab's fantastic version of VTI. It gives you a broad stake in the entire US stock market. All three are excellent choices with super low fees and broad diversification. You truly can't go wrong with any of them. Investing isn't a complete set-it-and-forget-it activity. You should absolutely continue learning about personal finance and investing. But be careful about information overload. The basics of successful investing haven't changed in decades. Diversify, buy low-cost ETFs, invest consistently, and hold for the long term. The most important thing I can possibly tell you is this. The best time to start investing was 20 years ago. The second best time is today. Don't wait until you have more money. Don't wait until you understand everything perfectly. Don't wait until the market crashes. Start now with whatever you have and begin building the habit that will create your financial freedom. Your future self will truly thank you for taking action today. Every month you delay is a month of compound growth you're giving up forever. The last thing I want you to do is to go watch the video above where I revealed the only 3 ETF portfolio designed to make you insanely wealthy. Don't forget to hit that subscribe button and share this video with anyone who needs to hear this message. See you in the next one.